So I have in my hand a Yeti vessel to drink whatever, cold, hot.
So do I.
So Yeti has gone up a tremendous amount, right? And I also have in my desk the Bible of security analysis written by Graham and Dodd. This is the 5th edition with all sorts of ratios and fundamental analysis, the stuff you teeth on when you're a fundamental analyst. These two things don't jive right now.
No.
Yeti stock trading at an unbelievably high multiple, and rationality in how we should invest long term. So that's our topic today. And I thought I'd let you just run with it at first and see where we go on this.
Okay, you set me up here. That's an interesting. No, I think I would agree with that setup in the sense that this week, particularly, so we've had a very exciting past week for sure in the market. I was thinking about it yesterday. The market is trying to, at least for me, yesterday I was trying to fight again those emotions, right? As an investor, it's trying to shake you out of perfectly good company. So this is really, yesterday I was trying to say, okay, what is the market trying to tell me? And everything seemed weird. So what we've seen in the past few days is a complete reversal of what we had seen for everything year to date, right? So we were used of a certain leadership and a certain way the market was working, and we've had a very sharp reversal of these themes in the past few days, right? And that is exactly at the heart of what you're saying. You see those things like Yeti and growth stocks that had done exceedingly well and were valued by the market to be replaced by a surge, a very, very sharp surge into the cheap stuff. I mean, honestly, the value style came back with a vengeance. I think we've had one of the sharpest reversal we had seen. So you see things like even like Walgreens, in the Dow Jones, just like popping up, like gapping up every day for 3 days. We kept an eye on this. I want to love it, but it was kept. You have to keep throwing good money after bad on that stock, but finally,
well, I've been in love with that stock for a long time from a value perspective, and you just can't hold on to it.
Exactly.
But I think we've hit the bottom in the value sector, and I think that's, or value style, I should say, and I think that's almost completely driven by a high potential of opening up. So I've been talking about this basic formula of reopening up the economy plus more stimulus equals big stock market rally. And we've had that breakout. And now you're seeing the participation moving down into those value stocks. But you're also seeing the leadership stocks initially sell off as investors have kind of rebalanced. But some of those leaders are continuing to move higher. So you can't ignore the growth side. That's what I think is happening right now.
Was hard to fight the past few days, because if you were positioned for what had been working, your portfolio probably you found yourself into a bit of a
downdraft
challenge right now. Exactly.
Yeah, we had a couple of days of our leaders selling off, and then you're looking at the S&P and the Dow and the Nasdaq bifurcating. The Nasdaq was down pretty good, over a percentage point, while the Dow was up and the S&P was up. And but that's really what's going on. If you go further underneath the hood, though, you still see that the growthy names are still doing well. Stocks that have certain things going on, like some of the, if you look at today, for example, we don't own this stock, but Jinko Solar is up 10%. That's one of the stocks in our QVT 100. So we have this list of quality, value, and technical, our proprietary way of kind of slicing and dicing the market. We've got like our top 100 stocks we're looking at. And that's one that's clearly still in the growth phase, kind of the more speculative phase, not as high quality, but it's trouncing the indexes today. So it's not like you can let go of those, and you still have companies like Big Lots that are beating the averages today. So it's a very good time right now to be a stock picker.
Yeah, and I agree with that, and that's what I was doing. I was going through sectors and see, okay, what do I like right now? What are some of those trends? You mentioned trend. The trend is your friend. This is an interesting time where we may have a shift in leadership, and the question is it an knee-jerk reaction or is it a sustainable move forward? And that's basically right now what you need to decide as an investor, where you want to position yourself to go forward. I mean, right now we've seen a very nice move up, like in energy and finance. I mean, those were the, for example, two sectors that had been neglected by the market for a very long time. We saw some good action in industrials and materials, and on the lower side, we've seen like some of the discretionary staples, like some of that old, kind of more cautious way, kind of going by the wayside. So, and of course, healthcare is one that has also shown some great signs of life in some pocket there. So, so I think I agree with you, and it's I think it's emerging, and I think you have to look forward to see what.
So I have a theory on that, JP. I have a theory that a lot of the movement that you're seeing right now is knee jerk, because with the hedge funds and how they're looking at things, they're kind of slicing things up into scenarios, and they're basket trading certain themes. And then also, if you look at the action, it's very clear that there's clear ETF movement that is happening that's driving a lot of it too, because there's a synchronicity across indexes, certain types of indexes that don't normally exist. And so you're seeing irrational stock behavior too, because there could be stocks that would be a part of an index that actually should be going up in this environment, but it's going down anyway because there are big market participants that are just placing index bets. So I think that's creating opportunities. So it's not as clear cut as I don't think it's as clear cut. I think you have to go through and look at each company and say what's going on with this particular company. And because I think we'll have some downdrafts as some players make this overall shift to value, if you will, away from the NASDAQ. And it will pound some companies that it shouldn't be, but those will snap back very, very quickly. So that's what I would be looking at, paying attention to, is the relative strength of those stocks as you like today, for example, big snapback in the leaders that are kind of thought of as NASDAQ stocks, but they're not fundamentally really like Apple and Amazon, if that makes sense.
Yeah, no, I agree with that. And I think that's what we have to see right now. We talked about more idiosyncratic and stuff, but we're still seeing that group reallocation, which is really related to indexing. When you talk about the Dow, you said, okay, there's a shift to value and more maybe of a risk on kind of a thing, but it's a cautious one, right? Because it's led by, the Dow type of companies. So people are not really going, down market and really looking at stocks and taking individual investor long-term bet, which is where we're looking right now. I did some work yesterday, and I was looking at to try to, again, to your point, separate what is a meaningful move for an individual stock versus something that is just moving along with the market. Because that's what we're trying to figure out. We saw a very sharp volume spike in the market on Monday, could have shaken up a lot of people. But when you look at it, like, you saw some stocks that had sharp sell-off, but they're just moving along with the market. So if you sell the entire index, every stock is also going to have a surge in volume, right? So I was trying to.
But there's a bifurcation in the index, though. There's a bifurcation in which index, and there's a lot of generalization, what's the word I'm looking for? Homogeneous trades. I remember one time when I was in a macroeconomics class, and I was young, and I was fascinated with macroeconomics. I didn't know what the word homogeneous, I knew what it meant because I looked it up, but I didn't know how to pronounce it. And I was in the middle, I don't know if I've told you this story before, but I was in a big classroom, one of those, huge classrooms where there's like 200 people in it. And I answered the question. I raised my hand. He asked the question. I raised my hand. And this was a guy who studied underneath Milton Friedman. So this was a smart guy. And I said, homogeneous. And everybody laughed at me. And then I remembered it's okay to look stupid sometimes. What matters is that you get the right answer.
Yeah, well, try doing that when you don't speak the language. I have these stories that we could spend the whole day telling you stories where I felt like a fool, both in French, English, and Spanish. So I've done it all in 3 languages. Um, so we
Triple
will
whammy.
we'll save that for another day.
But getting back to this thing, I did notice that in the rotation we did see some of the staples. There was a defensive element to it too. It wasn't just value; it was also defensive, because there was some really expensive defensive stocks that were moving higher too during this move, during this kind of rotation. And so I think that's something that you have to kind of consider, that there is an element of defensiveness feel to it as well. And you also have to understand, I think, in this kind of a market, that there's going to be some outperformance, and some of it may not in the value sector, but some of it may not last very long, because those companies, maybe they're cheap right now, but the value gap between expensive and cheap is not that big. And it's more of just a rebalance trade from a lot of institutional investors selling off the Apples of the world and buying them, but it's not like excitement about future prospects. So you have to be careful not to buy the ones that don't have good future prospects, and just be in a value. Like maybe you get a nice pop initially, that's fine for a trade. But if your time horizon is over a year, I think a lot of these stocks are going to go poop, move up, and then they're going to just die, fall dead like a flat dead fish. Mm-hmm. And so you gotta be careful with that. And there's still some true leadership in the growth area. That's my assessment. The other thing is, I think the small caps. You look at the small cap index, how fast it snapped back. You know, what tipped us off to the small cap bottom was that, first of all, they had been underperforming for a long time, and then we saw a bottom in the relative strength trend. So the actual strength of those the small caps relative to large caps bottomed out and started moving higher, and it was very quiet. Nobody was really talking about it. And then the other thing I noticed was that in our QVT model, a lot of high Q and Vs were up there. In other words, a lot of good value, good quality companies were there, but the T's, the technicals, were just starting to improve. They were just starting to move up the ranks. We have kind of a style way that we can look at that, and that was a really good tip off. That was a classic bottom that we saw there. And if we get a strengthening in this economy, like I think we will, then I think that has more legs. That plus emerging markets, I think, have more legs than some of these value plays, some of these old economy value plays. What do you have to say about that? What do you think about that?
No, I think you're right, and I think people. I mean, the market is not completely irrational. I was looking at earnings yields yesterday, and it's we said we've been in an environment where finding yield has been difficult, and this overexposure to high quality companies that are pretty much priced to perfection, right? If you look at this, like an Apple, or as about a 2.74 trailing earnings yield right now, is that really what you want? And you get a little bit for dividends. You like. This is not like we're talking about equity risk here, and this is pretty much your expectations of returns. The forward doesn't go up that much. The forward goes up to 3.6. It's not like there's a tremendous amount of growth potential. So when you talk about growth, I agree that growth is still a good place to be, but you got to look at again that price, right? What are you paying for that growth? And
right. That's my point. I think the value at a reasonable, or growth at a reasonable price. Well, it's two areas. It's either growth at a reasonable price with good quality, or it's hyper growth. Like
exactly the one that the market has a hard time pricing in. Our brain is not wired very well to do exponential growth, right? When we talk about that exponential growth curve, this is why we keep underestimating growth, and those stocks. Probably that's why they get mispriced, right? That's an opportunity we have there. So,
but utilities are higher today. Tech is leading today. When you look at these sectors, though, they're so heavy towards certain stocks. Mm-hmm. So we're obviously looking underneath the hood there. But I think there's so much generalization that goes on about the markets in terms of how people trade, and it gets really irrational. So like some of these stocks that are bid up, like Apple. I mean, Apple's a great company, obviously, and we keep picking on Apple. They're not the only ones.
It starts with
But
AA. It's always on top of the list. That's why.
there you go. And it's also on the top of the, it's on the top of the market cap too. So,
Yep.
but,
So
yeah, so if we could switch gears, if you don't mind, really quickly towards bonds, I've noticed the international bonds have been doing very well. And I just feel like we talked about adding that as a diversification part of a portfolio right now. None of the yields look attractive. The high yields have been outperforming recently just as a confidence trade. We saw a big divergence between the governments and the governments were getting pummeled while the corporate bonds were holding up better. You know, basically a confidence trade. How much more can we really get of that, though? Really, I mean, how much more confidence can we put in that spread between corporate and treasuries? Really?
well, I mean, I think that's another one, right? Where you have spreads that are very hard to justify taking that risk. I mean, we've been very cautious. I think it's an area we've been maybe overly cautious about moving up the credit quality, like moving down the credit quality, if you will, taking more yield. But again, I don't think I regret that positioning to in favor of maybe government and maybe go longer on the curve. That's been still a good place to be, but it's I mean, right now, unless there is a good surprise right now that maybe our fear of this this default is maybe was not as strong as it turns out to be. So I think we're showing some good signs of default and things like that. So I think that's giving some pretty good lift to the to your reopening theme, to the high yield area. And that's an area that we're looking at. I mean, for example, I think a trade that might be interesting is to look at a steepening of the yield curve type of a move. Really betting on the steepening itself, not necessarily on a positioning on the yield curve itself. So those are themes that I'm starting to investigate further.
Right. Well, I'm looking at a chart right now. I guess I could probably pull this chart up, but if you look over the last month and just look at the small caps are up 6.5%, 6.57% in the last month. And if you look at the treasury bonds, the 20-year plus ETF, it's down 3% in the last month. And, it kind of shows. But if you look at like Bitcoin, it's up 51% in the last month. There is still an element of fear that's out there. Let's see, what's gold doing? Gold has been trading with the market. It's almost lockstep. The correlation of gold will move in and out of favor, in and out of sync with the market. Right now, it's tending to move with the market. And interpreting that is a little bit rough, and I've heard different theories on that, but that is what is happening right now. There's definitely a difference there between what's going on. And the steepening of the yield curve, I think, is a possibility for a pretty good trade. But what does that really mean, though, JP? I mean, what do we just go short on the yield curve? And we're not shorting bonds, so what would we do on a steepening trade?
Yeah, I mean, exactly. And that's where I haven't implemented that strategy in our portfolios because, right now we probably have to look for a packaged product. I'm not liking what I'm seeing so far, like in an ETF. There are some ETF products designed to do it. They don't go too far. They really don't barbell enough for me. And those are not products that have a ton of liquidity, which worries me as well. So it is a challenge for the way we invest for our clients, which is mostly long only, and we can do shorting to be able to implement those ideas, right? So so that's where you have to look at.
Oh yeah, back in my futures trading days, this would be an easy trade.
Oh, that would be 2 minutes.
But for private clients, they're not in the futures markets. They're not using derivatives. And I don't think like there's a whole lot of upside to doing that. Like you might be able to get a little bit out of it, and maybe get a little edge, but we may not be able to get a huge edge. One of the problems is that you look at the benchmark, the Bloomberg Barclays aggregate, U.S. aggregate index. It's so heavily in the treasury world in terms of its weighting, and it doesn't really represent what an investor would normally put. In a lot of ways, it doesn't really represent what a normal investor should put in a fixed income environment. And that's the thing with different types of clients will have different kinds of needs on that fixed income element. But looking at that benchmark is really rough, because we always want to see like relative performance. And I just have a real problem with that whole index, JP. I do.
Well, it is. I mean, any the bond area, and that's the reason why I think active manager can still earn their keep in that space, because if you're trying to build a product like an ETF, you can only invest in things that have a lot of capacity, that are available widely, and the likes, and that's really not that's not where the action is. An individual bond manager is able to go and find mispricing both at the at the corporate levels, as well as the government government, and then really manage to those individual bond holdings. So I think this gives us an idea of the broad markets, use it as a benchmark. But I think the implementation. So I think there's two, like anything in investing, right? We could use those effectively to do a macro play, to put something in play very quickly, effectively, without having to worry about stock selection or alpha. Or you could go and say, okay, this is really about selection, both on stocks and bonds. And then at that point, then you have to decide whether we do it yourselves, because you have the capabilities and the ability to do it, or you hire a manager to fill that gap. So for example, we spoke last week about our emerging markets. We went in there very quickly using an ETF, and that gave us kind of the ability to get in on that theme very quickly. And then the question is, okay, do we replace that passive investment with some more active, specific,
it's really difficult to do that. Either hiring a manager that's got more, or as far as picking individuals, because it's just the access is not there. China is the real driver there. I mean, I heard this morning that, and I forget the name of the gentleman who is the chief strategist for a particular hedge fund, but the concept was, hey, we've got East and West, you've got China and the United States, and that's kind of driving a lot of what's happening. I mean, it's so funny because it used to be Europe and the United States, and I don't think we should just let Europe out of the equation. When you dive deeper into European stocks, though, there's a lot of old economy stuff going on in there. That's just the biggest problem I see in that whole sector, in that whole area. And they really need to. There's so much untapped potential in Europe to unlock innovation and stuff. They really need to deregulate and get some. And they've got a currency problem, and they really need to solve that, because that's such a potential powerhouse from an investment perspective long term. There's a lot of unlocked potential in Europe, in my opinion. If they unlock that, Europe will smoke. And right now, I don't see it, unless I'm, and I'm not an expert in Europe, but I'm just going, from what I know, that seems to be my perception of that. Do you have any thoughts about Europe?
No, they're there. There's good ideas, there's good companies, there's innovation. They're just very hard to get access to it, especially from our perspective. Again, it's a question of our the construct of what we can invest in. But you're right. I mean, right now there's a lot of structural kind of problems that maybe are stifling those leadership companies from emerging and really becoming global leaders. There is no reason why somebody out of France or Germany shouldn't be able to challenge the best the world has to offer in many areas, right? So I think that there's a lot there. And Europe is that puzzle, right? We keep looking at it. You want to love Europe, but then you dive into it and you're like, I can't find really that great opportunity. Like I want to get there, but
you might find 10 stocks if you're lucky.
Yeah, exactly. So,
and there's probably some smaller companies that are there and that might be an area of focus to find specialists in the smaller companies that can find those unique opportunities that somehow can break away. But I think that's something to look at. There's definitely a lot going on in the other countries too, like in Thailand and stuff like that. So, but getting back to the United States, I think that it's hard for investors right now, because you have to underweight bonds in order to get a reasonable rate of return today, period. and but you cannot stick your neck out so far that you're going to take unnecessary risk. So we're in a balancing phase right now for investors, and I believe we're navigating that pretty darn well. Now, the thing that I'm concerned about right now is that we have a runaway in tech again, and it looks like that may happen. Like we might have a runaway and a bubble. We're like, in my opinion, we're like 65% there to a bubble in tech. We're not where we were in the .com, but we're close.
Yeah. And that's what I think, go back to original point. Maybe that's one of the takeaways from today. Like, don't buy anything at any price. And that's the danger that happens with indexing. If you're buying the cubes, if you're buying a tech heavy ETF, for example, you're getting the good with the bad. If you do your homework, you can find the ones that are giving you value for what you're paying for. And again, do your homework right now, roll up your sleeves and do it. It felt very bizarre for me to sell our Amazon position in the past couple of weeks. And I know I'm probably going to hear about it but I'm like, okay.
Especially if it rallies further, which it probably will.
It probably will. That's fine. We're getting into Christmas, Black Friday, Cyber Monday, all these things. We can get back in again. We talked about not falling in love with your stock. It was the right time for us to generate again. It was really a capital allocation decision. Do I want to be in something that right now looks like it's going to give me subpar yield going forward, or do I want to and then reallocate those dollars to some more exciting ideas that I find in the small cap, into emerging areas? So that's really, that's the game right now. So that's where it's at. And I think a lot of that is going on. You're seeing a lot of people sending those names probably for the same reasons of capital allocation to different ideas.
Yeah, and some of those stocks that are being bought are not going to have a whole lot of legs. A lot of them, in my opinion. Some of them will, like some of the entertainment stocks. I really like the gaming area personally in that space.
I do too. I'm looking at some small stuff I won't name today, but some small equipment, stuff in the gaming area to support that are hugely well positioned. That thing is going on. I mean, we have spikes in usage of gaming, like on Wednesdays, because there's people without jobs. There's a lot of risk of we shut down, or at least we stay home for a little while longer. People are gaming. I mean, this is a great theme. That thing has left the building, but there's legs in it because it might be sustainable in many ways.
Yeah, it'll be sustainable. So the probabilities, there was an announcement, I believe, that a Russian company has a vaccine. I don't know if you saw that, just came out this morning. They said their efficacy rate was 92%. So we don't have a monopoly on good ideas. And so the probability of a vaccine is high. It appears that way to us. So if that's the case, you're opening up, baby.
Yeah.
And with the stimulus is going to continue. So, and I think you got to set aside all the election stuff beside you. So my philosophy is distance yourself away from from politics and find what is. What I mean by what is what is really happening right now. And regardless of the politics side, what is really happening, and then make smart choices. If you do that, first of all, your psyche is going to be a heck of a lot better. The psychology of many Americans is going down right now, and that people need to exercise, eat right, get sunlight, all that stuff. In what I'm calling a gap period, a period between when we actually do get the vaccine and open up, and right now there is a period of time that we're going to be having to struggle with, most likely. But if you can navigate yourself personally through that and make smart decisions and just look at what is, be accepting as to what is, don't be upset about what is, because if you get upset about it, and that goes for anybody, because I know people on the right that are upset. I know people on the left that are upset. It's like there's always going to be upset, but that doesn't get you anywhere as an investor, because it's our job to help you make money regardless. And you got to stay happy. I mean, I'm talking on the phone with people, JP. I've noticed people's psyche adjust, and it doesn't matter. People on the left and the right, it's not all their side. It's the pandemic, if you want to call it that. I mean, that's been a big part of it. You know, people are not unsure about what waves next and all that stuff. But as that stuff eases out, I mean, you're going to see some stocks need to really go a lot higher. So
good. I'm going to, we're at the end of our time. I think I'll let you have the last word on that. I don't, yes, I don't agree with everything you said, but let's leave it at that for today. So hopefully we gave you some good thoughts on our what we see as emerging trends, and again, it's about doing your homework right now, maybe more than ever. So do it yourself, have somebody do it for you. We love doing this.
Hey, we're always going to have disagreements, but what's good about it, see, I think we're a prime example of what should be going on. Two people with different views, but we're still buddies, and we've been working and know each other for decades, and with the same situation, right?
Yep.
And so that's where we're headed. I think the country's headed that way. So.
Yeah, I hope. I hope this takes place. The right discussions all across the country, in every household and every workplace. I think that's how we're going to get better. So,
JP,
cheers.
You're the man.
Have a good week.
You too. Bye.
Everybody. Bye.